Hello, my name is Jason Mercer. I'm the Toronto Real Estate Board's Senior Manager of Market Analysis. With the first quarter complete, I'd like to take you through my most recent housing market overview and outlook, both for 2013 and through the end of 2014 as well. And I'll break this discussion down into three key parts. First, we'll take a look at the sales trend and our outlook for transactions through the Toronto MLS system through the end of 2014. Then we'll focus in on price. So what do we expect to see in that relationship between sales and listings, and how's that going to feed through into price growth for different home types? And then finally, I want us to take a look at the condo market in particular. I mean, certainly we've seen a lot of interest in the housing market as a whole in the Greater Toronto area, but I think a lot of the focus has been on the condominium apartment market and whether or not we're seeing a bit too much supply and what we expect to see with price. So I want to drill down a little bit and take a look at some of the particulars of that market just to give a better indication of both where we've been over the last couple of years and where we might be heading through the end of 2014. So this first slide shows us, first quarter sales both in total and broken down by low-rise and high-rise home types. And we see that we've continued on with the trend that started in the second half of 2012, with sales down on a year-over-year basis. If you look at total sales, we're seeing that number off by about 15% in the first quarter of 2013 compared to the first quarter of 2012. Now, we saw a stronger decline in that high-rise or condominium apartment sector, with sales down by about 17.5%, and a little bit better of a result on the low-rise side of the market. So by low-rise, I mean singles, semis, and townhomes. You saw sales of those home types down by about 14% on a year-over-year basis. And of course, a key reason why we've seen these declines in sales over the last few quarters are the stricter mortgage lending guidelines that came into effect in the second half of last year, and particularly in July. So the finance minister announced in June and shortly thereafter in July two key factors that have fed through into a slower pace of sales. Number one, we saw the maximum amortization period lowered from 30 years to 25. And then on top of that, we also saw the removal of the government guarantee on mortgages or high ratio mortgages for homes purchased for over $1 million. And so whether we're talking about the bottom end of the market in terms of pricing or the higher end of the market in terms of pricing, or regardless of home type, we have certainly seen these changes in mortgage lending guidelines feed through into slower sales over the last 3 quarters. And so with that in mind, what do we expect to see in terms of the total number of transactions through the Toronto MLS system in 2013 and then even further out for 2014? Well, definitely for this year, I'm looking at about 80,000 sales in 2013. And so that'll actually represent an improvement as we move through this year, because if we saw total sales down by about 15% in the first quarter, well, this is only representing a decline of, say, about 7% in relation to what we saw in 2012. So obviously this means that we're expecting to see an improvement in the sales situation as we move through the second quarter of this year, and even more so as we get through the second half of 2013. Moving into 2014, I actually expect to see the sales situation improve. I expect to see sales up moderately to about 82,500, a slight increase over what we're expecting to see in 2013. And there's a couple reasons for this, and it relates to both population growth, and so what we expect to see over the long term. As we see our population continue to increase, we'd expect to see an upward trend in sales as well. So where are we relative to that sort of long-term trend that we'd expect to see in terms of sales? And number two, of course, sales are also impacted by affordability. And so we'll talk about both of those issues in turn. So we'll start off by looking at where sales are, or actual sales through the Toronto MLS system, versus what we would have expected to see over time based on population growth and, say, average sales per capita. And so obviously as we move through time, we've seen actual sales follow the population-driven trend quite closely. But in some years, we've obviously seen sales above that trend, like we saw, say, from the turn of the new millennium up until the recession, as shaded here in pink. And then also in the years following the recession, we've actually seen the number of sales a little bit below that population-driven trend, as we see here in yellow. And it's important to note with that in mind that we still haven't gotten back in terms of the level of sales. We haven't gotten back to that record level that we hit back in 2007 when we saw over 93,000 sales. But at the same time, it looks as if we sort of balanced out that sort of strong above trend demand that we saw in the first part of the new millennium versus what we've seen coming out of the recession. And so it would suggest that we should start seeing that actual sales trend start to move back towards what we'd expect to see over the long term based on population growth. And so that's one factor that's fed into my forecast for a slight increase in sales from 80,000 to 82,500 in 2014. But it's important to note that there have to be other conditions in place to allow this to happen. And most importantly, of course, is affordability. And so people still have to be able to go out based on their income, find a house that meets their needs, and go into a lender and qualify for a mortgage on that house that they're going to be able to comfortably pay for over the long term. And so that's the point. When we talk about affordability, we're thinking about, well, what share of a household's income is going towards those major housing payments, so mortgage principal and interest, property taxes, and utilities. And we could talk about borrowing costs first. And certainly in April, the Bank of Canada released their latest update on their target policy rate, the target for the overnight rate, and they decided to keep it firm at 1%. And in fact, the language of their release changed slightly to suggest that we were going to see that interest rate or that interest rate level at 1% remain in place for a certain period of time. And certainly if you look at what credit market expectations are for short-term interest rates in Canada, it tends to agree with that sentiment, with basically seeing very little change in short-term Government of Canada Treasury bills really over the course of the next year and a half or so through the end of 2014. Now, of course, when we're talking about the housing market, we're talking about mortgage lending rather than just sort of the short-term rate as defined by the Bank of Canada's decision. And so what we really need to think about then is sort of what's the yield on longer-term Government of Canada bonds as a starting point. So obviously the barometer mortgage rate in Canada is that 5-year fixed rate. So it makes sense then to take a look at the yield on the 5-year Government of Canada bond. And right now, we're very close to historic lows. And so as we move forward, the market expectation is that we're going to see a bit of an increase between now and the end of 2014, but very small, somewhere in the neighborhood of, say, between 25 and 50 basis points. And so that would suggest that towards the second half of 2014, we may start to see mortgage lending costs edge upwards a little bit, perhaps by the same amount over that period of time. But suffice to say, we're expecting to see borrowing costs remain quite low, and that's going to feed through still into quite accommodative mortgage borrowing costs over that same period of time. But of course, when you're looking at purchasing a home and taking on a mortgage to do so, you have to have the income to cover those costs. So it's always important to think about, well, where's the average household income going to go in the Greater Toronto Area over the next couple of years? And we certainly do expect to see the average household income in the GTA increasing both in 2013 and in 2014. This year, I'm expecting to see that average income increasing by about 2%, reflective of a little bit softer labor market conditions than we would have expected to see this year. But as we move into 2014, we're expecting market conditions to tighten up as growth in the overall economy starts to accelerate. So I'd expect to see average wages and salaries growing by about 3% in 2014, and that'll bring the average household income up to about $109,000. If we look back to, say, the late 1980s or early 1990s, we're seeing that between 50 and 55% of the average household income during that period of time was going towards those major home ownership costs, mortgage principal and interest, property taxes, and utilities. And that just wasn't acceptable based on generally accepted lending standards. And so as a result, we saw a real decline in the number of sales in the marketplace during that period. We also saw a real increase in listings, and the result was a protracted period of home price decline. And that's in stark contrast to what we're seeing today. If you look at where we are right now through the first quarter of 2013, we're seeing the average the share of average income going towards those major housing payments in and around, say, 34 to 35%. And that's where we'd expect it to be really through the remainder of 2013, and then edging up a little bit in 2014, moving closer to 36%. So that's higher than what we've seen in years past, certainly coming out of the recession, but it's still quite a bit below the 39% ceiling that was mandated by Minister Flaherty in the same changes to mortgage lending guidelines that we've already discussed. And so it's important then to circle back, because we've talked about interest rates, we've talked about where average household incomes are going to go, but at the same time, of course, the final part of this equation is where do we expect home prices to go? Well, I haven't made any change to my forecast for the 2013 average price. I still have it coming in at $515,000, and that'll represent about a 3.5% increase over the average selling price in 2012. And indeed, as we look forward to 2014, I do expect to see the average selling price to continue to grow, but at a more moderate clip than what we see this year, coming in at about $525,000. And so what's going to drive this more moderate pace of price growth, both this year and even more so as we move into 2014? Well, the first thing to consider is supply. So where are our listings going to be this year and next relative to what we've seen, say, in the years coming out of the recession? And the answer is we expect to see new listings higher than what we saw last year, moving up in both years by less than 10%, but coming in at about 170,000 new listings for 2013, and even higher as we move into 2014 at about 185,000. Now, when we look at the relationship between sales and listings, demand and supply over time, this relates quite closely to what we see in terms of average annual price growth. And so as we're seeing sales down in 2013 and expecting to see new listings up, then we're going to see a better supplied marketplace. We're going to see the ratio of sales to new listings edge lower. And as a result, we're expecting to see more moderate price growth of 3.5% this year. As we move into 2014, we're going to see sales up, but new listings are actually going to be growing by a greater rate. So again, we'll see even a better supplied market in 2014, and that's again why I'm forecasting to see a more moderate pace of price growth next year, coming in at about 2%. Now, this kind of brings us to the final component of the presentation, where I want to break out the condominium apartment segment. And it makes sense that we're using pricing as a segue. Because certainly if we look at the low-rise segment of the market versus the high-rise segment, it really has been a tale of two types. And this chart here shows months of inventory. So if we look at the purple line, that's the low-rise months of inventory, and we're very close to historic lows, at less than 2.5 months of inventory for low-rise home types, singles, semis, and townhomes. So it makes sense that it's been those housing categories that have been responsible for much of the price growth that we've seen this year and will continue to see through 2013. On the flip side of that coin, if you look at the green line, well, that's months of inventory for the high-rise component, predominantly driven by condominium apartments. And we're seeing that at the highest level we've seen over the last 10 years. And so it makes sense that when we look at that condominium apartment segment, we haven't seen as much growth in price, and that's because buyers have benefited from a lot more choice in the marketplace. And so it's timely to have this discussion about the condominium apartment market, because we've just released our first quarter reports dealing with the condo market in particular, as well as the rental market that's basically covering off average rents and listings and actual transactions garnered for condominium apartments and townhomes in the Greater Toronto Area. And so the real story, of course, in the condominium apartment market over the last few years has been very strong completions. If we think through, much of the second half of the first decade of the new millennium, we were seeing strong pre-construction sales. And a lot of these projects over the last couple of years have reached a completion stage. And so the extent to which some of these units were purchased by investors, or some of the original end user purchasers housing needs a change during the construction period, we have seen a strong uptick in the number of condominium apartment listings on the Toronto MLS system. And this has led, as we've discussed, to a better supplied marketplace. And so, if you look at, where high-rise occupancies have taken place over the last couple of years, we can sort of map it out GTA-wide. And we do see that, while there are nodes of development, both in the city of Toronto and the regions surrounding, we're still seeing the majority of those occupancies, or close to the majority of those occupancies, taking place in the downtown core. So Toronto C01 and Toronto C08. And so it's no surprise then that when we look at this next map dealing with new listings, new condo listings, we're still seeing about a quarter of overall new listings through the Toronto MLS system taking place in the downtown core, again C1 and C08. And so rather than looking at the trend for condominium apartment pricing for the GTA as a whole, I think it makes sense to perhaps look at condominium apartment nodes. And because the downtown core is sort of the predominant node within the Greater Toronto Area, let's take a look at where the pricing trend has gone for condominium apartments within that sort of smaller contained geography. And we see that, since the second half of 2012, as we started to see the impact of mortgage lending guidelines come into play, and we started to see a real decline in the amount of sales in that condominium apartment segment, we did see selling prices flatline. Whether you look at the average selling price or you look at the MLS home price index for apartments specifically, we saw sort of a flattening of that trend. But what's interesting to note is that even though we saw months of inventory quite a bit higher from an historic perspective, we haven't seen a marked drop-off in the average selling price for condominium apartments. Again, it seems to have sort of flattened out over that period. So that suggests that even with a better supplied marketplace, we're still seeing enough interest on the part of buyers relative to apartments listed for sale to exert at least or to provide at least a foundation for pricing. Now, not all of the new listings that we've seen over the Toronto MLS system have pointed towards the home ownership market. Some investors who purchase units at the pre-construction stage have opted to hang on to their unit. They have sort of a longer term time horizon when thinking about returns on their investment. They've chosen to rent their units out instead. Now, it makes sense that we're seeing close to half of new rental listings over the last year or so have taken place in the downtown core. Again, Toronto C01 and Toronto C08. But it's been a little bit different of a story because we've seen increases in the number of rental transactions as well as increases in the number of rental listings over that period of time. And so as a result, we have generally seen average rent increases over the last couple of years. Now, it is important to note if we look at this chart and you look at the green line, which covers new rental listings, we did see quite a spike in the second half of last year and continued on in the first quarter of 2013 that wasn't quite matched by the number of rental transactions. And so I think that goes a long way to explaining why we saw a bit more than the regular seasonal dip in the average one-bedroom rent in the first quarter of this year. It was still up by a substantial amount in comparison to last year, but that growth rate wasn't quite as strong. And I think the next couple of charts go a long way in explaining that. If we look at the rental to listing ratio in the first quarter of 2013, it was quite a bit lower than what we saw in the first quarter of 2012. And so just like we see in the ownership market, when we see a change in the relationship between demand and supply, we generally also see a change in price growth. And that certainly is the case when we look at one-bedroom rents, or the growth in one-bedroom rents on average this year compared to last. At a little bit more than 4.5% in the downtown core in the first quarter of 2013 versus about 6% during the same period last year. And so I think on the whole, if you think about the condominium apartment market, certainly on the ownership side, we've seen a better supplied marketplace. And that has resulted in a bit of a flatlining in terms of that price trend. But at the same time, even with that added supply, we haven't seen a marked downturn in the average selling prices. If you look at the rental market, well, we've seen relatively tight conditions carry forward into the first quarter of this year, and some of that could have to do with the stricter mortgage lending guidelines that came into place last year. People who otherwise would have been looking to purchase a condominium apartment decided to put that decision on hold and rent instead. And so that's led to quite tight rental market conditions. And even though we've seen a little bit more supply, we're still seeing rent growth well above the rate of inflation in the downtown core. And indeed, if you look at one-bedroom rents for the GTA as a whole, we're seeing those rents up as well above the rate of inflation. So that about wraps things up, and I just wanted to cover off a few summary points that cover the key themes that we talked about today. First of all, if you think about the demand side of the marketplace, sales will be lower in 2013 in comparison to what we saw in 2012. We're expecting to see about 80,000 sales this year, but as we move into 2014, I'm expecting that situation to improve slightly with about 82,500 sales next year. And market conditions are expected to remain tight enough to see upward pressure on the average selling price both this year and into 2014, but a better supplied marketplace over the next year or so will see a moderation in that price growth, moving closer to the rate of inflation next year. And finally, when we think about the condominium apartment in particular, it certainly will continue to be the best supplied segment of the housing market. And so driving price growth next year will continue to be that low-rise market segment. But at the same time, if we look at the trends that we've seen in the downtown core over the last few quarters, the type of supply we're seeing right now versus the kind of sales we're seeing doesn't necessarily suggest we're going to see any kind of decline in the average selling price for condominium apartments, but definitely more flat as we move through 2013 and into 2014. I want to thank you for your time, and I look forward to speaking with you again at the end of the second quarter. Thank you very much.